You see a company with a soaring stock price, glowing headlines, and a CEO on the cover of every major magazine. On paper, they're printing money. But 6 months later, they're filing for bankruptcy, and the shareholders are left with nothing. How does a profitable company just vanish? The truth is, the warning signs were likely hidden in plain sight, buried deep in the notes to financial statements of a 10K filing. Today, we're going into the world of financial forensics. I'm going to show you 5 accounting red flags that prove a company is faking its profits while it's actually going under. Number 1. The profit versus cash divergence. In accounting, net income is an opinion, but cash is a fact. If a company reports $100 million in profit, you'd expect to see money flowing into their bank account. But if net income is rising while operating cash flow is flat or falling, be terrified. Look at Evergrande. In 2024, regulators found they had inflated revenue by a staggering $78 billion. They were booking profits from apartments that hadn't even been built yet. On the screen, they looked like a titan. In reality, their bank accounts were empty because the buildings were just holes in the ground. Number 2. Exploding accounts receivable. Accounts receivable is money customers owe the company but haven't paid yet. If a company's sales grow by 10%, but their receivables grow by 50%, something is wrong. Think of it like a lemonade stand. If you tell your parents you sold 50 cups of lemonade, but 45 of those were IOUs from the neighborhood bully who never pays, you haven't actually made a profit. You've just made a list of people who owe you money. Take Wirecard. The German fintech darling claimed to have $2 billion in escrow accounts in the Philippines. It turned out those accounts didn't exist. They were using fake backdated contracts to simulate revenue that was never actually collected. Number 3. Capitalizing regular expenses. Normally, if a company pays its electric bill or repairs a truck, that's an expense. It hits the profit margin immediately. But creative accountants can sometimes classify these costs as assets. By capitalizing an expense, they move the cost off the income statement and hide it on the balance sheet. Suddenly, the company looks more profitable because its costs have disappeared into a category like property, plant, and equipment. This is how WorldCom managed to hide $3.8 billion in ordinary expenses, making one of the largest telecom companies in the world look like a gold mine when it was actually hollow. Number 4. The one-time addiction. Every company has a bad quarter. They might take a one-time charge for a lawsuit or a factory closure. But if a company has special, non-recurring charges every single year, that's not an accident. That's a cost of doing business. They're trying to hide from the bottom line. Management will tell you to ignore these and focus on adjusted EBITDA. Don't listen. If the bad stuff happens every 4 quarters, it's not a one-time event, it's the business model. Number 5. The auditor resignation. This is the nuclear option. Auditors are paid by the company, so they generally want to stay. If a Big 4 auditing firm suddenly resigns, run for the hills. Just look at Super Microcomputer. In late 2024, their auditor, Ernst & Young, didn't just quit. They stated they were unwilling to be associated with management's financial statements. When an auditor pulls the fire alarm and runs out of the building, the ship isn't just leaking, it's already underwater. Investing isn't just about finding winners, it's about avoiding the blow-ups. The next time you see a too-good-to-be-true growth story, skip the glossy press release. Go straight to the cash flow statement. If the cash isn't there, the profit isn't real. If you want to see a real-world walkthrough of how to find these lines in a 10K filing using a screen share, let me know in the comments. Thanks for watching. Keep your eyes on the cash, not the hype.